Welcome to Moving Market Podcast, monthly recap. And again, now we kind of doing the annual recap. Wish everybody a happy, healthy new year. David, looking back to last year, we had one of our better years, probably navigating the markets and kind of recapping what happened overall. But as always, let's recap. And what matters is what's going to happen this year and where we're going from here.
Yeah, Jared, thanks. Happy New Year, everyone. Yeah, as you said, looking ahead to next year is more important, but it still gives us a good foundation to see kind of where we're coming from. And as you look at last year, the S&P, ended the year flat on the month, but overall, a very strong year, up 16%. Tech really, drove a lot of that total return, and you saw that the S&P continued to outperform the equal weighted index. We'll see if that, shifts maybe this year as you saw tech, potentially slowing down and rebalancing to the rest of the market. And we did see that over the last few months of the year, value really outperformed growth. As you look across, other markets, mid and small cap companies, continue to really underperform, and they're in a difficult spot because, impacted more by higher interest rates, don't necessarily have all of the benefits from AI. And so they're in a more difficult position. But as you look at international, that was one area of great opportunity. And you saw both developed and emerging markets return 30%. And that's a trend that we expect to likely continue into this year as you see some of the, very large US companies, potentially people rebalancing and into some of the European equities or international equities where that could drive prices significantly. And then as you look at high dividend paying stocks, kind of back again to the value conversation, equity income had one of its best years as far as outperforming the index by double digits. But if you look at where the index was, it was, relatively flat. And the areas that benefited there, were some of the industrial names and financials as well. So that's something that we also expect to continue to do well this year.
Well, and David, I think as you come to 2026, as you said, the last couple of years, it's been more or less all about AI and the biggest tech companies driving a lot of the market returns. You started to see that change overall, and I would expect in 2026 to see, which we've seen the first week or so of trading, the leadership within the big tech, not all of them going up. I think it's going to be much more selective this year on where you want to position. And as always, as we start the calendar year, I think as you look to take a little bit of profit, rebalance from what did well over the last year, last couple of years, and stay diversified as always. And to your point, I think international, because, one of the main reasons our companies are so much larger than many of the overall market, total stock market exchanges overseas. I think you continue to see that despite, looking at our economy overall, we're still in great shape. I mean, look at the GDP, as we, end the fourth quarter. Looking at the chart, I mean, projected by the Atlanta Fed, we're north of 5% GDP for the fourth quarter. We'll see what happens with looking at the projections. So that's the green line, Atlanta Fed right there is north of 5%. And again, we'll see at the end of the month. But again, there's positive momentum. So there's no reason to believe there's a recession on the horizon for 2026. What's going to drive the markets? My concern the last six months or so is maybe the market goes too high overall, and that'll be the catalyst for some kind of correction in the market. But again, looking fundamentally at the economy, I mean, we tend to be in good shape overall. Labor market, look what's happened in David on the labor market the last few months. If you want to touch on that.
Yeah. So yeah, Jared, I think as you said, GDP, economic growth remains strong, but the area to watch is the labor market because we have seen that kind of softening and it still remains in relatively okay shape, right? You have the unemployment rate around 4.4%, which is still very low, below the 5% full employment target by the Federal Reserve, but still off of the lows. And as you look at it, continuing claims are not moving much higher. So again, people are, being laid off, but finding other jobs. And you've also seen the pace, I think, slow a little bit. So as you look at the job cut survey and the expectation for job cuts looking ahead, it seems like a lot of that was done in 2025. And again, as companies have better profitability, they're going to look less to cost savings. But as you look at, the last 6 months, because of a few months of significant job losses, particularly in October, and we'll get the final revision for November, which could obviously still change, but you've had about 24,000 jobs added over the last 6 months, which is about 4,000 jobs a month, and that's been a very slow rate of growth. So job growth, it has definitely cooled, and that'll be an important area to watch because we are a very consumer-driven economy. And as you look at the different sectors that really benefit, that are driven by the consumer, that's where you could see any potential further economic slowdown.
Well, and as you look to the Fed now, David, I mean, the Fed is going to be under the microscope the next few months, overall. And the challenge, as you said, labor market is much slower. Inflation, as we saw this morning, moving in the right direction. You're around 2.7% now. Overall, looks like we'll be heading to the low twos over the next few months. As you look at the chart of the data, overall you could see there's a gap with the government shutdowns. You see those two flat lines on the far right, shows where core and all items are at this point. And again, 2.6 and 2.7. So it's not to the 2% target the Fed wants, but it's dramatically lower than we started last year, overall. So it gives the Fed flexibility to manage things. On the other hand, with GDP as strong as it is, there's no reason to believe the Fed should overdo it. And as you look back to the balance sheet for a second, the Fed stopped tapering the balance sheet. And you can see here's the chart of the Federal Reserve balance sheet. So you can see the dramatic increase during COVID and what followed. And then you can see that the Fed has reduced the balance sheet substantially over the last couple of years. Now that tapering has ended, they've already talked about having to add some liquidity back in the market. So you'd expect that balance sheet to increase a tad over the next few months. But this could be something to watch for because one of the concerns I have coming into this year is, does the Federal Reserve get too politicized overall? And you're seeing some pressure, over the last few days with an investigation on things and such, and it's just a slippery slope. Same with trying to push interest rates down too much overall, right? I mean, the challenge you want, everybody wants lower interest rates to borrow at and such, but you need to have the stability of prices and everything that goes with that. So it could be fun in the short run from risk assets if interest rates go down a lot from this level. You could see a major increase, but what happens on the other end and where's inflation 9, 12 months out from there? So it's definitely a concern of to watch for in 2026. On the other hand, looking at the opportunities, right? I mean, as I said, the economy's in good shape. I think you're going to see a much broader participation within the market. As you said, David, we've had the S&P Equal 8 underperform for 3 straight years. Overall, there's good value in the breadth of the market, especially as you see the economy, recover more broadly than just tech overall. And then, looking at precious metals, what are some thoughts there, David?
Well, yeah, you've seen precious metals continue to advance, and gold has reached an all-time high. You have silver, copper as well, and some of that is driven by industrial demand, certainly, particularly in copper. But you've also seen, I think, this a similar kind of a bubble starting to form where, money has been coming out of crypto and going into precious metals, which again is similar type of an asset class, right? One is digital. Typically, it's an inflation hedge. But we don't see really inflation continuing, right? And as you just pointed out, GR inflation in the U.S. has slowed as well. So it seems like more speculation and mo money moving from one asset to another, where none of them pay a dividend. They don't have any earnings, right? So some of the challenges with just holding precious metals and other commodities.
Yeah, and as you said, David, I mean, it feels like crypto peaked more or less in October. Gold's taken another level up since then. It's probably the popular trade in the short run. Precious metals are moving. Let me get into something more exciting. We'll see how it plays out over the next few quarters ahead. But in general, I mean, looking this year, some other themes I think are interesting to watch. The financials, which had a great year last year, you results out from some of the big banks this morning, continue to have solid trajectory overall. Investment banking is strong. Capital markets are strong. You see a lot of IPOs this year. I'm guessing you'll see continued bank mergers overall, not the biggest banks buying smaller, but more mid-sized buying small. So I think you'll see more consolidation within the banking sector. Industrials, With the world events, you can imagine defense stocks, with the budget potentially doubling in the US and many other countries in the world, you're likely to see more demand from there. So those are areas to watch. And just the international stocks overall. But again, as always, we'll see what happens, this month and with the earnings season, it'll give us a guide for the rest of the quarter. So with that, we want to wish everybody a happy, healthy new year. We'll touch base next month.
Thank you.